Treasury Secretary Scott Bessent just called for a full review of the Federal Reserve as he questions everything the central bank's been doing and its tight grip on the U.S. economy. Could this be the first step in a full monetary reset? Stay tuned because I'm going to show you why. It is. Plus, tonight's show is brought to you by AgriForce Growing Systems. You can find them on the NASDAQ and the symbol AGRI, and they're carving a unique path in Bitcoin mining. Now, keep in mind, this company has a low float on their stock, meaning any news could send the stock surging, just like it did back on July 16th when it jumped 73% during intraday trading. This is one you don't want to miss out on. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now, let's turn to CNBC. As Treasury Secretary Bessent calls for a review of the entire Federal Reserve. And keep in mind, over the years, many people have wanted to end the Fed. We've heard from President Trump as he'd love to get rid of Fed Chair Powell, but found out he can't. And one of the problems here is the Fed has an incredibly tight grip on the economy, and there's really nothing anybody's been able to do to stop them. And this is a huge problem because right now we know they're keeping monetary policy in a tight, restricted position that could be holding back the economy, and even worse, could be the catalyst that plunges us right into a recession. But the problem is, right now, nobody's got the answer for the Fed. But Scott Bessent says, well, maybe there's a different path, one that could lead to a complete reset of the U.S. monetary system. What we need to do is examine the entire Federal Reserve institution and whether they've been successful. Well, the problem is we know they haven't been successful. And that's one of the reasons nobody wants to look at what the Fed's done and their history, because we can look at every time throughout the past. We can see every cycle they've been behind. We can see every financial crisis they've missed. And this is a major problem here, because if we were to review them and audit them, the argument that we even need the Federal Reserve in their current capacity would probably go away really quick. The problem is we don't have the tools to get rid of them. But perhaps what Treasury Secretary Scott Bessent is doing is paving the way for a full system reset. You're not going to believe how this could play out. Bessent is asked if the organization has succeeded in its mission. He said if this were the Federal Aviation Administration and we were having this many mistakes, we would go back and look at why this has happened. But the reality is nobody wants to go back and look at what the Fed is doing because they don't want to admit the truth that central banking is a complete sham and that it actually has no authority over consumer prices. It does nothing to drive labor markets up or down. And the problem is when they're behind the curve, as they often are, it makes the situations worse. And on top of that, when we look at past financial crises, we can see the Fed was completely inadequate. They didn't even see it coming, and yet even today, they still don't have an answer to why many of the crises in the past even happened. And on the decision to keep Powell in office, President Trump solicits a whole range of opinions and then makes a decision, Bessent said. So he takes a lot of inputs, and at the end of the day, it's his decision. But at the end of the day, there is one truth, and that is a sitting president does not have the authority to remove a Federal Reserve chairman. And this is a problem because how do you deal with an organization that's made so many mistakes and right now is sitting on a weaker dollar that's continuing to drop, an economy that's going the wrong direction, and what you're facing is massive regulations building up in the banking system that's constraining the economy, at the same time who is publicly admitting that they need to keep monetary policy in a restrictive place only because they believe expectations of where inflation is going to be right rather than what's actually happening with inflation. And again, this is a major problem because the Fed has made many, many mistakes. Let's look back at some of them because, well, it's not flattering. And on financial stability, they arguably played a major role in seeing the 2008 financial crisis via too low of interest rates. On banking regulation, they missed the vulnerabilities inherent in the balance sheets of Silicon Valley Bank and others. And on the issue of monetary policy, well, on this show alone, we've outlined how the Fed is completely behind the curve almost in every instant. But one thing you don't have to be behind on, and that is the stock for our sponsor of today's show, AgriForce Growing Systems. Again, you can find them on the NASDAQ and the symbol AGRI. Keep in mind, this is a low flow stock, about 2.5 million shares, and any news could send it surging higher as the stock is coming out of oversold territory according to the RSI and the MACD. Again, this is one you don't want to miss out on. again on the NASDAQ on the symbol AGRI. But let's talk about how the Fed is always behind the curve. In fact, there's something called the Taylor rule, which tells us where the federal funds rate should be based on a mathematical formula. Now, this shown in blue here against the federal funds rate in red. And we can see the Fed is always behind the curve. They're not tightening fast enough. They're not cutting fast enough. And policy is not in line with the economy. In fact, even if we threw out the Taylor rule and said, look, we don't need the Fed to set monetary policy anymore, we could just look to the bond market, which is really interesting because we've heard from experts over the year mention in reference to the Fed policy that they're behind the curve. Well, what do they mean by that? Well, simple. Let's take a look at 2-year Treasury yields shown in red against the funds rate in blue. And we can see that's the bond market that tells the Fed what to do each and every time, not just at peaks, but at the bottom as well. You can see in every instance, it's the bond markets that telling the Fed that, look, you've got overnight interest rates at the wrong amount, when that is very evident when you see 2-year Treasury yields, as we do right now, leading short-term interest rates lower at a time when we're going to hear from Fed Chair Powell here very soon that he's going to likely keep interest rates at their current level. And again, this is human emotion. This is the Fed being political here, not looking at the trajectory of the economy and instead focusing on inflation expectations without looking at the real data, which continues to show that inflation and demand is coming down. And this is a huge problem because if you want to stoke the economy right now, or if you at least want to put the brakes and try to turn it around, you can make the case where people have jobs, which they still do right now, and you lower interest rates, it gives them an opportunity to potentially borrow and spend money into the real economy. But again, is this the beginning of an end of the current U.S. monetary system? Well, we already got some information on that, and the fact that Treasury Secretary Scott Bessent is coming out and calling for a full review, which we know how this would go. Not to mention all attempts to audit the Fed in the past have all been brushed aside. But let's take a look at this next piece, because it's now clear we do have a trajectory that says it's time for the dollar to come to an end. And Trump signs a stablecoin bill, delivering a big win for the crypto industry, but perhaps setting the stages for a complete monetary reset. Now, I want you to keep in mind, one of the issues here is we cannot get rid of the Federal Reserve System. We cannot just shut them down. This would have to come through Congress. They're highly unlikely to do that. We already know we can't get rid of the current Fed chief or future Fed chiefs once they're elected. But could we actually pull the rug right out from underneath them? I'm going to show you how this crypto bill does it and why a lot of Americans and a lot of consumers all around the world are going to be eager to adopt this. And they said it would provide issuers with strict requirements for backing stable coins. And here's the key parts: cash or short-term treasury debt. Now, keep in mind, who monitors the cash markets? Well, that is the Fed. They're in charge of the dollar. And we can show you, and we'll look at a chart in a little bit, of why the Fed's policy is not working with the dollar right now. In fact, they've lost control of any control they thought they had. But the real issue here is, what if a stable coin was backed by treasuries? Now, keep in mind, how is a dollar backed right now? Well, it's backed by treasuries. The problem is consumers don't have a whole lot of choice. But going forward, they're going to have a massive number of choices here. And what this could do is completely undermine the dollar, undermine the Fed's authority. And next thing you know, you're on the first steps to a complete monetary reset. And Trump said the measure would, quote, secure the dollar status as a world's reserve currency, adding that losing that position would be like losing a world war, which is absolutely correct. Typically, you lose your reserve status when you lose a major war, but that's not the real issue here. This isn't about the dollar. This is about replacing the dollar. Because again, keep in mind, the Fed's in charge of the dollar. Who's in charge of stable coins? The banks and the markets. So what happens if these stable coins turn their back on the dollar and say, we only want to be backed by T-bills? Well, now you've got somebody that changes the game, completely undermines the Fed authority. And again, you're starting to see the early signs of a reset happening here, because again, we can't just get rid of the Fed. It have to come through Congress. But let's talk about crises, because this is an issue here. And rather than preempting crises, which the Fed has no clue how to do, regulators all too often react to them after the fact. We need to instead be more explicit about our vision for the financial system. So once again, Bessent is hinting here, our vision for the financial system, the future, not the present system, the system which we're moving to. And I really think this stablecoin law really sets the stage, because it gives those who issue it the choice choice between backing with cash, which I think people aren't going to choose, and treasuries. And I think that's the game changer, is we're seeing a shift here away from the dollar to something that is backed by treasuries. And again, money doesn't have to be paid in dollars across these, could be paid in stable coins just the same way. So keep that in mind. He suggested a bank regulator should review outdated capital requirements that, quote, place unnecessary burdens on financial institutions and reduce bank lending. This was in response to the fact that banks now have two sets of capital requirements. One, we've noted that they have to hold cash against things like treasury securities that are considered 100% safe by the financial system. So you can see none of this makes any sense, but what's going on here is the Federal Reserve is holding back the economy in multiple different ways. And again, there's no accountability here. So if you can't remove them and you can't actually close the institution down, well, maybe you could change it from underneath. And I think that's exactly what Bessent is hinting at and starting to tell the world what they're doing. Let's take a look at the federal funds rate against commercial industrial loans. That data shown in red on a year-over-year rate of change. There's two things I want you to see in this chart. One is the Fed's reactionary. Anytime there's a major slowdown in bank lending, the Fed cuts rates to spur it. The problem is it's often way too late. The other thing I want you to note is in between the gray shaded periods, which are expansions, look at where you see the rate of bank lending. It's actually at a fairly good clip. And that's where we get economic expansions from, not from these low levels down here. So you have multiple issues going on with the Federal Reserve System, and what you're seeing from Treasury Secretary Scott Bessent saying, look, what you're doing isn't working. You don't know how to set monetary policy. You don't know how to manage the banking system. We can't get rid of you, but maybe we can quietly replace you. Let's do away with the dollar. And I think the crypto bill does that. But now the question becomes is, how do you create bank lending? Well, I think in the end of the game, the way this plays out is consumers will have a choice when they deposit their money. They can either have it backed by T-bills or cash, depending on their choice, but they could also lend it to the bank for a higher return. I think there's more to this story that's coming, but what we're seeing right now, in my opinion, is the end of our current monetary system. The future collapse of the dollar is at hand, as you're seeing the Trump administration make moves very quietly to put in a whole new system, because the evidence as we look around the economy is it's not working. Let's talk about CocaCola, whose earnings beat estimates as strong demand in Europe helped offset the weakness elsewhere. Again, slowing economy, and there's not enough money. Look at this. Net sales rose 1%, but their global unit case volumes fell 1% in the quarter. So what you're seeing here is evidence that inflation rose the sales price up, but demand is weaker. In fact, every division but Coke's Europe, Middle East, and Africa businesses reported shrinking volume. That's decreasing demand. Because when you think about a debt-based economy, what you need is new money created to fuel expansions. And that's one of the issues, is we're not getting out of the monetary system, and that's why you see demand start to go down. We talk about how paychecks are shrinking relative to inflation. This is a real issue. If there was enough money growth in the system, that wouldn't be as much of a problem. Demand would come back enough, and you would see supply meet it. Inflation would naturally come back to an equilibrium. But let's turn to General Motors, whose profit falls as Trump tariffs add $1.1 billion in costs. And here we see, once again, we warned about this in the UK, profit warnings. Well, here's one from GM. Net income still declined 35% to $1.9 billion compared with $2.9 billion in the second quarter. The car maker said it can offset 1/3 of its $4 to $5 billion in tariff exposure later this year as more of its mitigation efforts begin to fully take hold. Of course, we know what that's going to lead to. We talked about this again in the show the other day as we looked at the UK. Profit warnings lead to layoffs. We know this is what GM is going to do. It's all because the economy is slowing down here, and the Federal Reserve is doing absolutely nothing to help turn it around. And we can see further evidence as we turn to the 5th District Manufacturing Survey, this from the Richmond Fed. Check this out. The composite manufacturing index fell to -20 in July from -8 in June, now remain in negative territory. All three of its component indices fell as well. Shipments decreased to -18 -18 from -5. That means less demand there. New orders dropped to -25 from -12. Again, a drop in demand. And what did I say happens when you get a drop in new orders? Employment fell to -16 from -6. Again, manufacturers in the Richmond area are laying off. Again, this is a major problem here because when we look at the data, what do we see? Capacity utilization, -14, meaning less of the factories are getting utilized. You can see service expenditures at -16 here, continuing this negative trend. You know, we talk about why manufacturing leaves services. It's because they spend money into the services sector. Look at the response then again, still remains negative, only getting worse. But how about the services sector? Well, it actually improved slightly in July, but the current employment index edged down to 0 in July from 2 in June, while forward-looking index, this for employment, fell to 4 from 15, meaning employers no longer optimistic about the labor market, suggesting that as the economy slows down here, you're going to see an increase in layoffs. You're going to see more companies like GM warning about profits. You're going to look at companies like CocaCola who may beat in terms of how much money they brought in, but as demand continues to go down, you're going to see it's going to have a major impact on the economy. And when you tie this back to what Treasury Secretary Scott Bessent has said, what you could be seeing here right now is the beginning stages of a full monetary reset for the United States. But something we are bullish on, and that is a stock for our sponsor of today's show, AgriForce Growing Systems. Again, you can find them on the NASDAQ under symbol AGRI. And again, everything you need to know in the pinned comment and description below. Because AgriForce Growing Systems combines innovative technology with sustainable practices to lead in Bitcoin mining and digital infrastructure. The company focuses on energy-efficient solutions for digital assets. And this integrated approach positions AgriForce to meet the rising demand for computational power. AgriForce leverages underutilized natural gas to power its off-grid Bitcoin mining operations. The strategy ensures cost-effective and sustainable digital infrastructure development. And this company aims to scale its mining capacity to meet global computational needs through its digital division that's scaling its Bitcoin mining operations with high-efficiency facilities in Alberta and Ohio, which could capitalize on rising cryptocurrency prices and its Bitcoin treasury strategy. And AgriForce has launched its Alberta site, deploying a 425 kilowatt Blue Flare energy module for Bitcoin mining. The site is now operational with miners generating Bitcoin daily, marking a key step in the company's decentralized compute strategy. This expansion strengthens AgriForce's position in sustainable, energy-efficient digital infrastructure. And they've reaffirmed its strategy to allocate up to 50% of capital raises to Bitcoin acquisitions and retain 50% of self-mined Bitcoin for long-term holdings. This approach enhances financial flexibility and aligns with the company's focus on digital asset growth. It positions AgriForce to capitalize on the rising value of Bitcoin and decentralized computing demand. And we think this could be the catalyst to send its stock higher. And despite recent price declines, some technical indicators like the 3-month MACD buy signal and oversold RSI on the 14-day suggest potential for a short-term rebound. With a float of approximately 2.5 million shares in a recent reverse stock split, AgriForce has the potential for significant price volatility, and you can think back to earlier in July. On the 16th, the stock jumped 73% in intraday trading based on a press release. Again, we could see that setup again thanks to its very low float. And led by CEO Jolie Kahn, a trailblazer in Bitcoin mining, AgriForce boasts a team with deep expertise in digital infrastructure. The leadership's innovative vision drives the company's push towards sustainable, high-impact mining solutions. This positions AgriForce as a standout in the evolving tech landscape. And again, you can find them on the NASDAQ under symbol AGRI. And as always with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.